Are you thinking about paying off your mortgage earlier than you can? Most of us homeowners have 30-year loans, at least 90% of them, and you pay a lot of interest. Just as an example, on a $400,000 house, and if you put 10% down, you end up paying almost $850,000 by the time you paid off. That means you pay over $450,000 just in interest. In this video, I'm going to show you 3 simple tricks and ideas how you can accelerate the payment of your mortgage. You can pay it off 5 years early, 9 years early, or up to 10 years earlier, or even you cut your payments in half. So if you have a 30-year mortgage, you can pay it off in 15 years. And if you have a 15-year mortgage, you can pay it off in 7.5 years. I will also talk about the benefits or the disadvantages of paying off your mortgage early, because there are 2 thoughts to each side. So welcome to my video. I'm Mike Patel, by the way, and thank you for coming and watching my videos and on my channel. So basically, I'm going to talk about 3 ways to pay off your mortgage earlier, and then briefly talk about, is it better for you to pay it off early, or is it not better to pay it off early? It may apply to you, it may not apply to you. And if it applies to you, you're welcome to use those techniques. I myself have been paying off early every year since the last 15 years. In fact, I refinanced in 2016 for a 15-year loan at a low mortgage at 3% back then, and I should be done in the next few years, pay off my mortgage in half, because I'm applying the principle that I'm going to talk about. I also sell homes to a lot of people that I know, and I always recommend that if you can pay off your principal early, it's always a great idea. So let's talk about the 3 things you can apply to pay off your mortgage, and which may be the best one for you should you decide to apply this principle to your mortgage. By the way, on a side note, most homeowners have a 30-year mortgage, and most people refinance again. So as I mentioned to you earlier, on a $400,000 house, you're paying almost $850,000 with interest if you keep it for 30 years. But when you refinance, let's say you refinance after 10 years, then you start the clock again. So all the interest you paid over the last 10 years gets wiped out, and you start another 30 years. So in a sense, you may end up paying $1 million on a $400,000 house. That's why I highly recommend that you apply paying extra principal to your mortgage, become debt-free earlier, become mortgage-free earlier, and have a better lifestyle once you're paid off on your mortgage. So the tip number 1 on paying your mortgage is very easy, it's very common, and a lot of my clients use it. Is a simple technique. It is like paying 1 extra mortgage payment per year. So for me to explain to you very easily and very simply, let's take an example on an actual mortgage payment. So let's take a house that's on average $416,000, and I'm using $416,000 because according to Zillow, in Q2 of 2023, the median price home in USA was $416,000. So if you take a $416,000 home and you put 10% down, and we take an average rate of 6.5% today, almost September 2023 in a few days, then on a 30-year mortgage payment, your principal and interest payment on a monthly basis is $23.64. Of course, there's usually principal and insurance, but I'm not going to talk about that, because even after you pay off your mortgage, you still have to pay your property taxes and you still have to have insurance on it. So in this example, your mortgage payment is $23.64, and just to give you a little scenario, your total interest you will pay if you keep it for 30 years and don't make extra payments, you will end up paying $477,016 on interest, plus your $416,000 your principal you have to pay. So the total cost of the loan will be $851,016. So if you buy today in 2053 of August, you would have paid $851,000 for the house that's costing you $416,000. That's a lot of interest, and that's why you want to pay. So the number 1 tip is pay an extra payment. And how do you do that? Well, you can always pay the principal of $23.64 per year. So the best way to do it is you take your $23.64 divided by 12, which is $197 of principal every month. When you send your mortgage payment, whatever it is, $23.64 plus your property tax and insurance, add $197 every month, like a clockwork. Every month you pay. Of course, check with your lender or your bank. Some allow you to pay early or extra payments, some don't. Most of them do within reason. So if you pay $197 a month every month for the next 10, 15, 20 years, you will pay off your mortgage 5 years and 10 months earlier. So let's analyze those numbers. So you take the 30-year loan, your loan amount is $374,000 by putting 10% down. Your mortgage payment is $2,364, but you're adding $197 a month additional. So if you do that, you pay off 5 years and 10 months early by making those payments. A simple $197 a month. So let's look at what happened by paying $197 a month extra. So over the years, you would have saved 5 years and 10 months in payments, and your savings, total savings would have been $108,813 over the life of the loan. So by paying almost $200 extra, which is almost 10% of your mortgage payment, you would have saved $100,000 by the time you paid off your loan, which is a lot of money. So this is one of the reasons you want to pay off earlier. And if you can pay additional amounts, let's say you get a bonus or tax refund or you inherit some money, pay it off here and there, your interest, pay off $5,000 here, $2,000 here, $500 here and there, whenever you can, apply it to your principal if your lender or your bank allows it, and you can even pay it off faster. So in this case, on a 30-year loan, by paying $197, you're pretty much paying it off in about 24 years, which is almost a savings of 6 years of payment. That's a pretty good feeling when you paid off 6 years earlier. By the way, a few months ago, I did a video similar to this called No More Mortgage and how to accelerate your payments. And I talk about 8 different tips, simple tips, just like this in that video. So if you want more than 3 tips, like I'm going to talk today, please visit that video. It's called No More Mortgage. The link will be in the description and also towards the end of this video. And also please subscribe and make comments so we can all share each other's comments and learn from each other's comments. So let's look at tip number 2, how you can apply to pay off your mortgage early. So in this scenario, again, we're going to take the same house, $416,000, 10% down, 6.5% fixed for 30 years. In this case, it was $2,364. So the other way to do it, even if you want to accelerate it even faster, then what you do is you take your half of your principal and interest. In this case, it will be $1,182, and you pay every month $1,182 extra going towards your principal. Again, that's very critical. When you send these payments, either you pay it separately and let the banks know that each payment will be applied to the principal, or if you send a total check, one check of $2,364 and a second check of $1,182, let them know that the principal extra $1,182 applies to your principal. It's very critical because you don't want to apply it to your interest. So if you do this, if you pay half of your principal payment every month for the time of your loan or until you sell your home, hopefully you're going to keep it for 30 years, how much are you going to save in total interest payments? Well, let's look at the report on this scenario number 2. Your original term is 30 years. Your additional principal payment is $1,182 per month. So your total accelerated payments is $556,701. So by paying half your principal every month extra, your total savings would be $295,227, which is a lot of money, almost over $250,000 that you save by paying extra. And your mortgage is shortened by 16 years and 11 months. So by paying half your principal extra every month, you knock out 17 years in this example from a 30-year mortgage. Now, of course, you might be thinking, hey, Mike, are you crazy? I cannot afford $1,182 a month. Well, you'd be surprised. I know some people who are doing it because what they've done is they've cut back on their lifestyle on other things. They didn't buy a fancy car. So instead of buying a $70,000 car, they bought a $50,000 car. So you might save $500, $600 a month there and apply that payment to the principal. If you have a lavish lifestyle and you go out and travel and have dinners every week or 2 or 3 weeks, you may want to cut back. Or you might have a second income in the family or 2 or 3 income together. So apply one salary towards this. I've seen it done and I've seen some of my clients actually doing it. It's a big sacrifice. But remember, if you read the book, The Next Door Millionaire, which I read 15, 20 years ago, and I highly recommend it. Most millionaires in USA are not the ones that drive Lamborghinis or Teslas or buy expensive $2,000 suits or go on lavish vacations. Most millionaires are wearing the same suit for the last 10 years, probably driving a pickup truck like Warren Buffett did, or buying a Camry instead of a Lamborghini. And the way to become rich is to be frugal. So if you become frugal more than you are right now, you can increase your principal payments. So if you cannot pay $1,200 on a $25 payment extra in principal, pay $300 a month, pay $400 a month, pay $500 a month, and you can reduce your mortgage by 7 years, 6 years, 8 years, 9 years. So whatever you can afford to pay, do that. I'm just here giving an example how applying number 2, half your mortgage, half your principal and interest payment every month, you can pay off your mortgage in half the time. A 30-year mortgage, you paid off 16 years earlier. What a great feeling. Applying technique number 3 or tip number 3 is to cut off your mortgage payment in less than half. In this example, I'm going to show you on a 30-year mortgage how you can pay it off in 10 years, let alone half. So how does this work? It's the same as tip number 2. So what you do is you take your principal and interest. In this example, it was $23.64 a month. So what you do is every month you pay an additional $23.64. So instead of paying $23.64, you double that. That's a lot of money. But hey, it can be done. I have seen at least 2 clients of mine are doing it because they have double income. Their kids are working. They all stay together. So they all chip in to the principal and interest payment. Of course, when the times are tough or during tax times, if they cannot make it constantly every month, they can skip a few months. But in this example, I want to show you how the numbers work so that you can understand that simple principal payments, extra payment, make a big difference. Let's look at the report to see how much of numbers that you save and how much of time you save on your mortgage payment. So if you look at this chart, your additional principal payment was $23.64 per month. So your total scheduled payments was $851,292, but your total accelerated payments was $490,260. So you almost paid $500,000 extra. So your total savings by doing that is $361,668 of principal. So your mortgage was shortened by almost 21 years and 4 months. So on a 30-year mortgage, you pretty much paid off your loan, your mortgage payment in 9 years. So if you bought it today, 2023, you paid off by 2032 and you are debt-free, you're mortgage-free. So that's a real good feeling. So you may ask the question, do I want to pay it off early? Well, I myself have a few more years to go. I'm very excited because I'm paying almost $3,000 a month payment because remember, I refinanced in 2016 on a 15-year mortgage and my mortgage was not a big amount. So I was paying $3,000 a month and then on top of that, I was making additional payments so I can pay it off in half the time. So I'm very excited. It gives me a sense of security. It gives me a sense of peacefulness. And I know that after a few years, I don't have any mortgage payments. I won't have any car payments. So when I retire, I will be debt free and I'll still be making income because I'm still planning on working a few more years or a lot more years. And I'll have a lot of income. So it's a peace of mind and sense of pride and sense of security that I don't have 30-year mortgage or 15-year mortgage and I can spend the way I want because I've worked hard. I've been frugal. I've been consistent. I've been disciplined in making those payments, whether it's $200 a month extra or $300 a month extra or $1,000 a month extra, or when I got extra money like a tax refund or a bonus money at job or inheritance money, or I won the lottery, maybe at scratch lottery made $10,000. I paid towards the principal. So if you can keep paying towards your principal consistently, you will knock out 3, 4, 5, 9, 20 years from your mortgage. Hope you do it and hope you can apply whatever you can towards your principal. You will be glad you did. So I'm going to talk about the advantages and disadvantages. So let's get to those. So let's talk about the advantages, which I already did in a way. The advantage is if you pay off earlier, you are paying a lot less in principal and in interest. You get paid off earlier. You'll become debt-free sooner and you will have a peaceful, hopefully retirement life, peaceful life, debt-free life. So those are the advantages. And after you retire, let's say in 7 years or 10 years, you can apply that mortgage payment that you're saving every month. You can start buying stocks or mutual funds or invest in other properties, etc. Because now you can do whatever you want. You're not forced to do anything. You have this $3,000 like I'm paying almost $3,500 a month. I don't have that all of a sudden. And if my income is the same, which it will be the same or even increased, I can take that $3,500 and start applying to my retirement, for example, into mutual funds or 401ks or index funds or angel investing or even in syndications. So that's the advantage. Also, the other disadvantages, by the way, before I give you the disadvantage and before you do any of this, I highly recommend that you talk to your accountant or your CPA and see what makes sense best for you because each scenario is different. There's tax consequences. You may want tax write-offs when you retire because you'll make more money, but if you don't have any interest payments, you may not have that tax advantage. So for long-term planning, maybe you are applying for your 5-year plan, 10-year plan, 30-year plan for retirement and future goals. The other disadvantage I just want to talk to you briefly is, let's say you have a mortgage payment of 3%. Let's say for me, I did have 3% in 2016 and I'm paying extra. Maybe it's not wise for me to pay that extra principal because I only have a 3% interest rate. If I would have taken that $500 extra and put it in a mutual fund, by the way, I do have mutual funds and my average mutual funds right now are averaging about 6 to 8% for the last 5, 6, 7 years. So I could have said, wait a minute, why am I paying a 3% mortgage off if I can put that $500 $500 into a mutual fund or buy stocks or buy index funds or bonds or whatever, I can make more, 5, 6, 7, 8, 9%. Yeah, that's very true. And I could have done that, but I chose to be debt free, because what if there's a stock crash when I retired and all my money is gone? That could happen. That's the difference between real estate. In real estate, in the long term, your assets never go below your principal amount. So if you invested $400,000 in a house, it will always be $400,000 or more, never less. In the long term, it may go down in 5 years and 10 years, but over the long run, your real estate asset never goes down. Whereas in real estate, if you bought stocks in Tesla or any other stocks, crypto or whatever, if you put, let's say, $5,000 or $50,000 in stocks, your principal at some time during a crash could be $40,000 or $30,000. So it's your decision to make. In my case, I decided to put $500 a month towards paying off my mortgage because I wanted that peace of mind and I wanted to pay it off earlier, which I am doing. But at the same time, as I'm in real estate, my business is commission based, when I had some good years, and I've had some really good years, especially in 2020, 21, and 22. Even this year is not a bad year. It's a decent year. I took some extra money, and despite paying $500 a month into my principal, I also kept investing in stocks and angel investing. And I bought mutual funds where I open up an IRA account and a self-employed pension plan. And I still keep putting that in addition to the $500. So I'm getting advantage of both. So on one sense, I'm investing in stocks and bonds. And on the other side, I'm paying extra principal to pay off my mortgage. So I'm taking advantage, and I was lucky to do that. You may not be lucky enough to do that, or if you're lucky enough to do that, you may start doing that. So those are the advantages and disadvantages of paying it earlier. The other disadvantage of paying earlier, let's say the $500 towards your college education, and start saving money. Or instead of paying that $1,000 a month extra in principal, you could have bought after 4 or 5 years another investment property, right? And then have a second investment property. Yes, that can be done. Or you can do both, pay $500 a month and then save up, and then in 8 years buy another property by having that down payment. So there are a lot of variation. What's applied to you is different than what applies to me. But if you have a plan, if you look ahead 5 years, 10 years, 30 years, and apply this principle of paying your mortgage earlier, and or at the same time investing a little bit of money, pay a little bit principal, invest in other investments, in a rental or in stocks and bonds, you will be glad you did. Because remember, there's a survey done 20 years ago, and the survey shows that more than 95% of all the people who retire in USA are either broke, rely on the government, or rely on friends and family. They don't have savings accounts. So if you pay off early, if you invest right now, you won't be in that situation. If you have any questions on how to apply these principles, please direct message me. I'll be glad to talk to you or refer you to somebody, a financial planner or an accountant, so that you can talk to them and set up a plan. I'm glad you watched this channel or my video. Please look at this video, No More Mortgage, where I talk about 8 hacks on paying off your mortgage earlier.